All right, we should be getting the HCL Tech numbers anytime now. Okay, there it comes. 1873 crores is what they've reported. That's much higher than what ours was 1742. But 1873 compares with 1834 crores last quarter. So that is an increase compared to an expected fall in the profit. Just waiting for the other numbers. This is the only number that has hit the screen at this point in time.
So that's a 2% growth on a quarter-on-quarter basis versus a degrowth of, or rather downtick of 5% that the street was expecting. So straight away on the bottom line, there's a bit of a beat, but we'll wait by for more numbers. On the top line, we're expecting a dollar revenue growth of around 3.2%. But let's go across. Rima's waiting by. Rima, this is the only number we have. Anything more that you're picking up in terms of HCL Tech's numbers?
Hi Lata, hi Sonia. Well, I've got the numbers with me. The key number is dollar revenue growth. That is coming at 1433. So that is falling short of our expectations. It's a growth of 1.9%. So it's actually much lower than the 3.2% that we were anticipating. And it's also much lower than peers like in Infosys as well as TCS. Infosys growth, remember, was a little more than 3%. And TCS yesterday delivered about a 6.4% growth. So on the top line, actually, this is a big miss. And we've noticed that in HCL Tech, in constant currency terms, the dollar revenue has actually been declining. This quarter, the revenue growth in constant currency has come in at 3.2%. So they've got hit quite significantly on the back of cross-currency growth. Apart from that, the rupee revenue has come in at 8735. Now that is slightly lower than what we were at, of 3.7%. That the key number margin be. So I'll try and get you what the margin is at 2088. So the EBIT margin in absolute terms looks fairly healthy. So it's another quarter where I think the margin performance will be pretty healthy. And this has been the story of HCL Tech for the last few quarters. The operational performance has been exceedingly strong, but they're falling short of street expectations on the dollar revenue. And now most of the analysts are saying that the stock, in terms of the stock price, there are diminishing returns to improving operational performance. For the stock to do well, you need to see the company do well in terms of the top line, and over there is a bit of a mix. So overall, absolute EBITDA, it's at 2088. Do you have
Rima, no, we don't have the margins. Yes. We'll leave you to calculate and come back to you in just 1 minute or less, because Sandip Agarwal of Edelweiss Financial Services is joining us on the phone line for a first take. Sandip, 1834 on the PAT is a very significant jump of about 2% compared to an expected downtick of 1742, a downtick of 5% that was expected. So PAT up 2%, revenue actually up only 1.9. Our poll expectations, dollar revenue growth was expected at 3.24 to $1452 million. It's actually come in at $1433 million. As well, EBIT is good. Expected at 2065, they have run 2088, which is about 2% higher than the 2038 that they reported last quarter. Quick thoughts?
Yeah, so I think the top line number definitely is looking weak at 1.8%. It is definitely much lower than estimate. But PAT number is slightly better, but I don't think there will be much excitement because of the PAT number, because revenue growth is generally the key number to see. And I think from that perspective, definitely these numbers are not exciting for sure. We have to see further details, and we have to also figure out whether there is any one-off or any of those.
All right, Sandip, we're coming to exactly that, because Rima has just read maybe one take of the results. Rima, have you got the EBIT percentage and any other details?
Yes.
Yeah, go ahead.
Well, I have the EBIT percentage. It's come in at 23.9%. So it has declined by about 30 basis points on a quarter-on-quarter basis, but it's better than what we were anticipating. We thought the margins would decline by 70 basis points. The reason the margins were expected to be lower is on account of the wage hike. So they managed to offset the impact of the wage hike pretty well. So margins are looking quite good, and they have been hovering in this band of at least 23 to 24% for the last 3 or 4 quarters. And this is higher than the management's comfort management band of margin band of 20 to 21. So margins are looking good, but the miss is actually on the top line. And let me also point out about infrastructure, management services. Remember, this is the mainstay of growth for the company. In FY14, it has seen a growth of 33%, but in the last few quarters, it has reported a sedate performance. This time around, In constant currency, it's managed to come in at 5.2%, and in reported currency, infrastructure management services, the key dominant growth area, has come in at 3.5%. Now, the question we'll have to ask the management is that, are these historical high growth rates of 9 to 10% that we saw in this infrastructure management services, are we going to, go back to that? Because at least in the last 4 quarters, they've been averaging a growth of 4 to 5%, and this is at a time when peers like TCS, if you remember, had come out with a growth of 16% in this quarter in infrastructure management services. Competition is picking up, so that is another monitorable that we were watching out for. Apart from that, I'll quickly run you through what they've done in terms of geographies. America has done very well. It's a growth of 5.7%. Europe is okay, 2.7%. Rest of the world has seen a degrowth. In terms of the various verticals, steady performance from financial services, a growth of 3%. Manufacturing has gone up by 5.3%. Some dip or degrowth that they've seen in life sciences and healthcare, as well as public services. And in service lines, we spoke about infrastructure management services. Some pressure witnessed in the other side of the business, that's industry application, that has seen a degrowth. So just to summarize it, growth seems to be driven by America this quarter. Infrastructure management services has bounced back compared to the previous quarter. Manufacturing has clocked in a steady performance. Retail has done very well, and this is at a time when TCS, we just heard Chandra talk about some miss, lower than expectations on retail. So retail has actually performed well for HCL Tech, and financial services has also been growing well for the company, and that has been in line with company average. Deal wins, it's another quarter where the deal wins are extremely robust. It's a $1 billion of deal wins that the company has signed in this quarter, marking the 7th or 8th consecutive quarter of deal wins for HCL Technology, 15 transformational engagements. Now, the other question that we'd like to ask the management is, why are these robust deal wins not translating into a superior revenue growth, Lata? So that's also the other question that we'd like to ask. So these are few of the details that I can hand it, with that I'll hand it back
Would
to you.
it be very important, doesn't HCL disclose attrition rates or utilization rates?
Yes, they do, but I'm still trying to, get...
Fine, we'll come back to you in a second.
Press release.
Right, Sandip Agarwal, if you could hear everything that she said, it looks like margins, although lower than what they did last time by 30 basis points, is still better than what the street was expecting. Street expectations are polled through of 23.45, they've done 23.9. EBIT as well has come in at 2088 crores versus expectations of 2065. Would you say even if revenues disappointed, margins have held up?
So margins, I think margins are okay. So like 60 basis point, 50 to 60 basis point of outperformance versus expectation is there in margins. So I don't deny that fact, but I think still margins will not be important, because in a quarter when where Infosys reports more than 3% growth, and where TCS is any which was reporting more than 3.5% constant currency growth as well on an organic basis, there a company like HCL, which has persistently been announcing more than $1 billion of deal every quarter, in spite of that, if the revenue growth is coming so low, then there has to be some strong reason for it to hold. Otherwise, definitely it will be taken little disappointing.
Alright, some more internals coming out. The utilization rates as well have fallen for them to 82.7 versus about 84.5 on a quarter-on-quarter basis. The attrition rate has gone up for them at 5.9% versus 5.3%. That's the attrition for business services on a quarter-on-quarter basis that has gone up. So there are many other internals that are disappointing as well. Some more geography-wise numbers coming out. America's business has gone up by 5.7% quarter-on-quarter, while the Europe business has gone up about 2.7%. Sandeep, now that we have the top three performances, TCS, Infosys and HCL Tech, HCL Tech is the weakest of the lot in terms of the dollar revenue growth. So how would you stack up all three? What would your preferred pick be now?
So our preferred pick was earlier as well Infosys, and followed by HCL Tech and TCS, but we cannot change our calls just on one quarter numbers and all those things. But obviously Infosys will be a preferred pick because it was earlier also preferred over all others. But we have to see if there is any specific problem in case of HCL. But I don't think we will change our stack just based on few numbers without even speaking to the management on this. So it is too early to comment on that side, but this number looks definitely weak.
I take your point, Sandeep. Compared to expectations, both HCL Tech and TCS have faltered. Do you think Tech as a pack is now going to see some creaming off?
I think if you see tech stocks are generally priced to perfection, so that is the that because of that primarily there is some corrections. But see, as long as demand environment is strong, and US recovery is happening, I am not very scared about the long-term outlook. Yes, there could be some pressure in near term, but as long as fundamentals are there, there is no challenge to that.
Okay, Rima, have you pored over the press release a little more? Any observations, questions for Sandip?
Yes. Well, constant currency growth has actually picked up compared to what they did in the previous quarter. So yes, the reported dollar revenue growth is quite disappointing at 1.9%. They've gotten hit very badly on the back of cross-currency headwinds. So constant currency growth is at 3.2%, a pickup compared to the 2.8% that they clocked in the previous quarter. So that is the other point. Utilization, as you guys pointed out, has actually dipped a fair bit. So from 84.5, it's come down to 82.7, and at least in the last 4 quarters, they've managed to hold up their utilization above that 84% mark. This quarter, it's dipped a bit, but then, it's roughly in the range of 82 to 84%, so it's not something you need to worry. Attrition has come down a bit on a quarter-on-quarter basis. Yes, it's quite high at 16.6%, but it's come off a tad bit, and that is important because in this quarter you generally tend to see employees leaving, for higher, further studies. So, containing attrition is important. The gross margins have come down, and the other point that I think all the analysts will be watching is SG&A as a percentage of revenues. It's extremely important for HCL Tech, because one grouse against the company is the company investing enough back into the business, because SG&A as a percentage of cost has been dipping consistently. Last quarter it was already at an all-time low, and this time it's fallen even further. From 11.77%, it's come down to 11.68%. So SG&A as a percentage of revenue has been consistently coming down. It's a fresh record low over there. Once again, raising that question about, is the company investing enough into, back into the business at a time when TCS, has been investing, as you just heard the management, they're saying we're okay to operate in our margin, comfort margin band of 26 to 28%. Anything extra that we get, we will invest it back. We've been investing in Japan, in digital, etc. So the question, so SG&A as a percentage of revenue will be, some clarity on that will be watched out for. So overall, to quickly summarize the numbers, these are not a great set of earnings. There is a miss on dollar revenue. Margins have been maintained. It's a slight beat, but as we pointed out, in terms of a stock price, it's now factoring in diminishing returns to improve operational performance. So that can no longer be the stock trigger. It has to be the top line growth, and over there it's fallen short of street expectations.
Yes, ultimately India is a growth story, and every company has to show revenue growth. Margins will only be a palliative. Constant currency growth is better, isn't it? From 2.8 an improvement to 3.2.
Quarter on quarter.
Yes, but the street will not be happy because they were looking for 4%.
It will alleviate, some concern that they had on the top line growth. But again, it's still lower than what we were at, saying that, constant currency growth was expected at 4%. It's come in at 3.2%. So it's just that it's a pickup compared to, the last quarter, and they've gotten hit on account of cross currency. That's the only reason they're highlighting the constant currency growth this time around. But overall, you look at it either way, the constant currency or the dollar revenue growth, it's a miss compared to expectations.
All right, Rima, thanks for that. We'll keep coming back to you in case you have more details for us. But for now, we'll take a break. We'll be back in time for some more trading ideas. Remember, this earnings season, we're giving our viewers an opportunity to interact with the heads of the biggest companies in our country. Just send us your questions on this mail ID, ceocall@network18online.com, and our anchors will put them to the CEOs and the MDs when they come on our shows.